Hello, this is Mijun from Biktusilon University. June 23rd, let's begin today's Biktusilon news. Welcome once again to Mijun, where we consistently uphold the fundamentals of investing in United States stocks. Mijun family, I hope you all had an enjoyable and relaxing weekend. Here in Cambridge, where I'm staying, the weather was really nice over the weekend for the first time in a while. The weather forecast you're looking at now is for this week. This week too, the high temperatures will reach 26 or 27 degrees and the sunny weather will continue. Especially last weekend, for the first time in a long while, the temperature went above 30 degrees. So, for the first time in a while, I really enjoyed the hot weather that I love. In about a month and a half, I'll be moving to Malaysia. So I started thinking that I want to enjoy the hot weather soon. I want to sweat a lot and really experience the heat. Since I walked around a lot in this hot weather for the first time in a while, my face got a bit sunburned. I'm not sure if it shows well on the screen. Just like when I lived in Indonesia, now that I'm moving to Malaysia, please keep in mind that I might appear on camera with a tanned face. The United States-China broadcast continued even over the weekend. Last Thursday, I shared a pre-recorded video of the United States Stock Elementary School with Chief Executive Officer Kim In-jung, and especially in Part 1 of the United States Stock Elementary School, broadcasted on Saturday. I made a very important announcement to all of you. So, if you haven't watched this video yet, I highly recommend you check it out. And as I promised during Saturday's broadcast, we've started the 50% lifetime discount promotion for Choice Stack. This time, the event period is a surprise sale from June 23rd to July 2nd. As I explained in detail during the broadcast, the event benefit is that you can get a lifetime 50% discount on the annual subscription for Choice Stack Q. A link will be provided so you can download the original textbook for the United States Stock Elementary School as a portable document format. And there's one more piece of good news that Chief Executive Officer Kim In-jung shared with us. There's also good news for those who have already signed up as Choice Star members. When it's time to renew, you won't need to apply separately, and you'll continue to receive a 50% lifetime discount. If you haven't watched the Saturday video yet, I recommend you check it out. In addition, the Mijun All-in-One membership is also offering a 50% discount. Regarding this, I plan to share a sort of personal statement with you all. Besides this broadcast, another video will be uploaded today. I think it would be great if you could watch it with keen interest. Alright, then let's get started with today's United States stock news prepared for June 23rd. This is the Monday broadcast that starts off the week. Today, I'll start by summarizing the United States stock market trends from last week. First, let's take a look at the S&P 500 map. I've set the time period to 1 week. At a glance, you can see that the market was mixed. So some stocks went up and about half of them seemed to go down. From what I can see, there are more stocks with a vivid red color. So even though there are a lot of green stocks, the green is generally a bit dull. So you could say that red is a bit more dominant. And there's a very interesting phenomenon that I've noticed. As you know, last week, with the heightened tensions over the war, the United States stock market couldn't really rally. But if you actually look at the performance by sector, the safer sectors actually dropped even more. If you look here, most of the healthcare stocks were in the red. And if you move over to utilities, which are traditionally considered safe as well, there's hardly any green there either. And finally, although it might be hard to see right now, commodities are also mostly in the red. So you can see that the sectors traditionally called defensive stocks actually showed even greater declines. In fact, if you look at the performance of the major indexes in the United States stock market over the past week, the S&P 500 closed down by 0.46%. The Dow Jones was down 0.25%, and small cap stocks fell by 0.15%. On the other hand, the Nasdaq 100 was up 0.02%. It was almost flat. So, we can say that large cap stocks performed relatively well. I think that's a fair summary. Now let's take a look at the VIX index. The VIX has risen to 20.8. As you all know, the United States attacked Iran. So when the big news broke on Saturday, the tension in the market was already reflected in the fear index. But it didn't go up as much as expected. Actually, 28 is the historical average. So overall, the market still looks quite calm. It continues to maintain a quiet trend. It's the same with the fear and greed index. It's currently at neutral. Because it's at 55, it's just below the greed level. So, you can see that there aren't many investors in the market who are nervous right now. Next is the market score provided by ChoiceStar, and the market score continues to show a stable trend. There's no sign of it dropping from the head to the shoulders. It continues to maintain the 77 greed level. Let's take a look at the performance of Mijun Top Pick over the past week. How was it over the past week? 8 stocks were found to have gone up. Cred Technis performed the best. It jumped by as much as 16.36%, delivering the best return. Secondly, AMD maintained a very strong performance with a plus 10.40%. Third, Celestica was up 7.90%. Vistra Energy up 6.53%. Talon Energy up 4.15%. NVIDIA up 1.32%. And Broadcom up 0.52%. Lastly, the trade desk closed up 0.40%. Most of these stocks are artificial intelligence beneficiaries. So last week, most of the rising stocks were also artificial intelligence. Related, you can see it that way. Next, Palantir fell slightly by 0.07%. Meta was down 0.08, Uber down 0.18, TSMC down 0.75, Tesla down 0.97, Amazon down 1.14, Strategy down 3.44, BIT down 4.13, and Bitcoin dropped 4.26% with 101,610 trades. Google was down 4.60. Lastly, as the solar energy sector overall plunged, Nextracker showed the biggest drop at 5.09%. So far, we've reviewed the United States stock market trends over the past week. Next, I'll go over the major market catalysts lined up for this week. This is the schedule for June 23 to June 27, 2025. First, on Tuesday, Jerome Powell, the chair of the Federal Reserve, is scheduled to testify before the House Financial Services Committee. How dovish or hawkish will his tone be? Depending on this, the market sentiment could suddenly change. And if you look further down on Wednesday, Jerome Powell is also scheduled to testify again at the Senate Banking Committee. But by Tuesday, we should already have a sense of what Jerome Powell is thinking. And on Wednesday, NVIDIA's annual shareholders meeting will be held, so you can expect various news related to NVIDIA to be announced. And this week, Friday, is the most important day. The core personal consumption expenditures, price index report for May will be released. Right now, the most important economic indicator is inflation. So, you can see that a lot of attention is focused on the level at which the personal consumption expenditures price index, which is the Fed's preferred indicator, is maintained. But this week, there's something even more important than the personal consumption expenditures. It's the situation between the United States and Iran. As many of you already know, over the weekend, there was surprising news that the United States carried out airstrikes on 3 Iranian nuclear facilities. Many of you were probably very shocked, so today I think we should start by reading articles related to this. Well, over the weekend, it's likely that many of you saw various news reports about the war through the media. So today, I'll just organize and share my own thoughts with you. Now, first of all, the United States once attacked Iraq. So, by looking at what happened back then, I think it would be good to check how things might unfold this time. The date when the United States carried out its attack on Iraq in the past was March 19, 2003. And here are the results of the analysis of the S&P 500's returns based on that point in time. It's an unexpected result. First of all, after 1 month, it showed a 2.24% increase. So in just 1 month, it already turned positive instead of negative. And after 3 months, it went up by as much as 11.50%. Usually, we expect an annual return of about 10% from United States stocks. But after the United States bombed Iraq, the S&P 500 had gone up by as much as 11.5% 3 months later. And after 6 months, it was up 13.95%. If you look at the return after 1 year, it was as high as 28.85%. So, what lesson can we learn from this? In the end, war only has a temporary effect. Therefore, as I repeatedly mentioned last week, a catalyst like war cannot stop the long-term trend of the United States stock market. It may dip for a moment, but then it continues on its path. I think we can confirm this once again. But there is something we need to be careful about here. If you look here, 2003 was the information technology bubble, the dot-com bubble, the dot-com bubble. After the collapse, the major downtrend was reaching its end. And it was a time when the United States Federal Reserve was strengthening low interest rates and liquidity support, continuously lowering interest rates and expanding liquidity. That means it was a period when they kept buying bonds. You can see it that way. Therefore, as the war risk eased and the policy business cycle turned upward at the same time, the annual return surged by nearly 30%. That's how it can be summarized. So, you shouldn't interpret it as the stock market going up just because the war ended. As I mentioned earlier, war is something that, in the end, you can't stop the market's trend. But this doesn't mean that the United States stock market will always go up after a war ends. You shouldn't interpret it that way. Now, let's compare the situation in 2003 with the current situation. So just like you see here, we can compare them by dividing into three categories. And among them, I think there isn't much difference in terms of geopolitical risk. What's important is monetary policy. In 2003, it was a period of ultra-low interest rates and expanded liquidity supply. On the other hand, as of 2025, due to inflationary pressures, the tightening stance is still being maintained. The base interest rate is extremely high right now, so the personal consumption expenditures inflation index being announced this week is very important. I can emphasize this once again. There's one more piece of data, and that's valuation. In 2003, as the information technology bubble burst, the price-earnings ratio had dropped to around 15 times. But now, the 12-month forward price-earnings ratio of the S&P 500 is in the high 20s. Therefore, at the moment, the multiple is quite high. You can see it as being a bit higher than the average. Now here's the conclusion. So rather than geopolitical conflicts or war itself, the Fed's interest rate policy, market valuation, and the economic cycle are more decisive factors for mid to long-term stock prices. This is something we can check once again. The current macro environment is somewhat different from 2003 in terms of market valuation and inflation. Therefore, as the war risk is resolved, there is a possibility of a short-term surge. However, my personal judgment is that a sustained upward trend is only possible if the macro situation supports it. And I'll read you one more thing. In this article, it was about how, as the United States attacks Iran, investors need to ask themselves 6 questions. I'd like to add one more question for you here. Let's take a look. Currently, the United States stock market is already vulnerable to a correction due to rising valuations from the rebound in stock prices and uncertain tariff policies. For over a month now, the United States stock market has surged at an incredible pace. We saw a V-shaped rebound, so right now, most stocks have experienced a sharp rise in valuations. But the problem is, there is still no certainty regarding the tariff policy. So, if even a little bit of bad news comes out, it's a vulnerable situation where a correction could occur. This is something we need to try to understand. And another thing is that the White House's deferral on certain tariffs is scheduled to expire at the end of July. The reason the stock market has shown a V-shaped rebound so far is precisely because of the White House's tariff deferral. But the thing is, this is going to expire soon. Especially, the White House's 90-day deferral on tariffs targeting China is set to expire on August 12th. Because of this war, there is a real possibility that trade negotiations with China could be disrupted. I think we need to consider this point. In other words, it's a market with a lot of uncertainty. As I keep saying, what the market dislikes the most is uncertainty. When people don't know what will happen in the future, many investors pull out of stocks. Therefore, at this moment, uncertainty is really increasing, and we need to acknowledge this. In this situation, the United States attack on Iran is very likely to lead to a potential further surge in oil prices. I mentioned that there were 6 questions in this article, right? One of them was this: how will oil prices react, and what impact will it have on inflation? This was the 4th question. The price of Brent crude, which is the benchmark for international oil prices, has already risen more than 30% from its low in May and is approaching $77 per barrel. Iran is in a very disadvantageous position right now. If that happens, there's growing concern that the Strait of Hormuz could be closed. If that happens, the supply of crude oil could drop rapidly, and there's a possibility of a global energy price shock. We need to take this into consideration. Now, if oil prices go up like this, two potential risks could emerge. First, if oil prices surge further, it can fuel inflation. Since oil prices make up a large part of inflation, if oil prices rise excessively, there is a high possibility that inflation will also go up. We need to pay attention to this point. Second, there is a risk that the economic growth rate could decline. So, if inflation rises and the growth rate slows down, that's what we call the famous stagflation. Therefore, from an investor's perspective, the most disliked and feared term, stagflation, is likely to become a greater risk. We can take a look at this part. Now, what about the costs involved in war? It could worsen concerns about the size of the United States budget deficit. Right now, the size of the United States budget deficit is already very large, which is a huge burden, and war requires an enormous amount of spending. Therefore, if this war doesn't end soon, there's a possibility that the size of the United States budget deficit could increase exponentially. So investors need to reassess the proportion of cash in their portfolios at this point. Now, if by any chance the market faces another correction or downturn, does my portfolio have the strength to withstand another difficult period? That's what I'm talking about. We need to ask ourselves if we have enough funds secured to buy stocks enthusiastically when prices fall. Now, the answer to this seventh question is something only the investor himself knows. I think this is a good time for you to check for yourself what percentage of your total funds you are currently holding in cash. Next, we'll move on to Tesla. In the case of Tesla, there were two major pieces of good news over the past weekend. One of them was so significant that the other didn't get much attention. As you all know, Tesla has finally launched its long-awaited robotaxi service. I think many of you already understand the details about this through various media outlets. So today, I will share with you another big piece of news. Another major positive development that hasn't received much attention because of the robotaxi. Tesla? It's amazing news that Tesla has signed its first contract to build China's largest grid-scale battery power plant. Now, here's some welcome news. Tesla has just signed its first contract to build a grid-scale battery power plant in China, even amid the tense trade relations between Beijing and Washington. And when this project is completed, it will reportedly be the largest of its kind in China. So, not only is it the first contract, but it's also on a massive scale. That's what's really impressive. What about utility-scale battery energy storage systems? They help the power grid maintain a balance between supply and demand. Now, what does this mean? Thanks to these systems, we can resolve the supply and demand mismatches caused by intermittent energy sources like solar and wind. Now, usually with solar power, the sun is only up during the day. So we can absorb a lot of energy during the day, but the problem is we can't use it in the evening. That's why we need an energy storage system. We secure energy during the day and can use this stored energy in the evening. It's not just solar power, it's the same for wind power too. When there's a lot of wind, we generate energy and store it in the energy storage system, so we can use it even when there's no wind. Therefore, in the case of clean energy, the energy storage system is extremely important. You can see it that way. The Chinese media outlet Yikai appears. Citing Reuters, that's 4 billion yuan, which amounts to $556 million. So this contract isn't just the first one, but it's actually a huge deal. We can confirm that part. Tesla announced that its battery factory in Shanghai produced over 100 megapacks just in the first quarter of this year. The Megapack is a battery designed for utility-scale deployment. So it's not just a small battery for simple use, but a utility battery, meaning it's used in the power grid and is on a massive scale. That's how you should see it. 1 Megapack can supply up to 1 megawatt of power for 4 hours. Tesla said through Weibo that grid-side energy storage power plants are smart regulators of city electricity. As I mentioned earlier, they absorb energy when the sun is up and then regulate it so it can be used when the sun is down. That's what they're saying. Therefore, the grid refers to the power network, and it helps to flexibly control power grid resources. They're saying that our energy storage power plants are very important, and they go on to boast that it can efficiently solve the pressure of city power supply and ensure the safe, stable, and efficient power demand of the city. And they also stated that when this project is completed, it is expected to become China's largest grid site, that is, energy storage project connected to the power grid. According to Tesla's website, each megapack is sold at just under $1 million in the United States. At $1 million each, that's extremely expensive. However, the price within China hasn't been disclosed, and personally, I think it might be a bit cheaper. And this contract is very significant for Tesla, especially as China's contemporary Amperex Technology Co., Limited, and the automaker Build Your Dreams are competing with similar products. And especially, you see contemporary Amperex Technology Co. Limited mentioned here. This company holds 40% of the global market share. However, according to sources from Reuters, contemporary Amperex Technology Co. Limited is expected to supply the battery cells and packs used in Tesla's Megapack. Therefore, you can see that these two companies have established a partnership. The recent contract that Tesla signed with the Chinese local government is even more significant because it comes after President Trump imposed tariffs on Chinese imports, which heightened geopolitical tensions between the world's two largest economies. Because, as we know, Tesla's Elon Musk was one of President Trump's closest allies in the early stages of the trade war. And it made the business outlook for American car manufacturers in China even more complicated, because he acted as Trump's right-hand man. That's why, if the relationship between the United States and China worsened, Tesla could have been negatively affected. In the midst of all this, hearing such positive news from China is a very desirable development. That's how you can see it. Let's wrap up with a word from Mijun. What about Tesla's energy business? Now, it is being evaluated as a key growth engine that stands shoulder to shoulder with the automotive business, surpassing the level of just a side business. Even just a short while ago, there was the automotive division and the other divisions, but honestly, there was no need to pay attention to the other divisions. However, now, as the growth rate has strengthened, the energy business is rapidly developing to the point where it stands shoulder to shoulder with the automotive business. Both the sales growth rate and profit margin have started to surpass those of the automotive business. Some analysts on Wall Street are reassessing the potential of this business, even citing it as a key factor driving Tesla's market capitalization value. If you look at the latest earnings reports for 2024 and the first quarter of 2025, Tesla's energy business is showing tremendous growth. In 2024, the annual revenue of the energy division surpassed $10 billion, and the year-over-year growth rate was 67%. Now, this trend continued in the first quarter of this year as well. Automotive sales slowed down significantly, but during that time, the energy business continued to maintain a high growth rate. Now, another thing is that the profitability is also impressive. The gross profit margin of the energy division reached 26.2%, surpassing the profit margin of the automotive sector. That means it's not just about simple sales growth anymore, but it's a high profit business. In other words, it's a very valuable division that directly impacts earnings results. So as a result, many analysts now are even projecting that within the next 10 years, the value of Tesla's energy division alone could reach hundreds of billions of dollars. And another thing, the size of the market is also significant. The global grid-scale battery market is expected to reach $32 billion, or about 44 trillion won by 2030. It's projected to grow even further, and the entire large-scale battery market is expected to reach about $320 billion. Therefore, if Tesla can become a key player in this massive market, it stands to benefit the most. If that happens, Tesla will have another growth engine strengthened. Right now, electric vehicles have been performing very poorly, and as a result, Tesla's stock price has dropped a lot. But yesterday, the robotaxi was finally launched, and a contract has been signed for the construction of a grid-scale battery power plant like this. Therefore, we can expect rapid growth in energy storage going forward. And there's one more thing. Humanoid robots. Therefore, not only cars, but several growth engines that could drive up Tesla's stock price in the future are being discovered at the same time. This part is positive. Now, some investment banks are also saying this. Some even compare Tesla's energy business to Amazon's Amazon Web Services. Now, what this means is that in the early days, Amazon Web Services actually contributed almost nothing to Amazon's revenue. It was a cloud service originally built for their own use, but once they started selling it, now in fact, most of Amazon's total profit comes from the cloud. So, just like Amazon Web Services seemed like a side business for Amazon, but eventually became its core source of profit, recent analyses suggest that Tesla's energy business will follow a similar path. So, Tesla's energy storage business is now becoming a key growth driver. And another thing is, the energy storage market still has a lot of potential to expand. It's really just getting started. So as the green energy market grows and expands, I personally believe that Tesla's energy business is also something to watch with great anticipation. Just a moment ago, we talked about the diversified growth engines that Tesla is developing. Now, Tesla is no longer just a simple electric vehicle company. Starting yesterday, autonomous taxis, robot taxis, have been officially launched. And recently, the growth and profitability of the energy storage business have also been showing a very strong trend. And finally, although there hasn't been any significant contribution yet, humanoids are also expected to make a huge impact in the future. Among them, humanoids are a very important potential market, not only for Tesla, but also for NVIDIA, which we are fond of. I'd like to talk about this part this time. Taiwan's Foxconn and American artificial intelligence chip manufacturer NVIDIA are discussing deploying humanoid robots at Foxconn's new factory in Houston, which will produce NVIDIA artificial intelligence servers. These kinds of articles are being reported. So what about this story? It's amazing news that humanoids can help make NVIDIA artificial intelligence servers. So, this will be the first case where NVIDIA products are produced with the help of humanoid robots. From Foxconn's perspective, it will be the first artificial intelligence server factory to use humanoid robots on its production line. So, what about this deployment, which is expected to be finalized in the next few months? It will be an important milestone in the introduction of humanoid robots, which are expected to transform the manufacturing process. Just thinking about robots making artificial intelligence servers in the future is amazing. There's a high possibility that efficiency and productivity will increase dramatically. Foxconn is developing its own humanoid robot together with NVIDIA, and a humanoid made by China's UBTECH has also come for trial operation, and also both companies. Foxconn's new Houston factory aims to deploy humanoid robots on site by the first quarter of next year, when it will begin producing NVIDIA's Gigabyte 300 artificial intelligence servers. They stated this directly. It's not clear exactly what tasks the robots will perform in the factory, but according to Foxconn's press release from last May, the company has been training robots to pick up and move objects, insert cables, and perform assembly work. There is a subsidiary called Foxconn Industrial Internet, which is in charge of Foxconn Group's artificial intelligence server business. Here, the head of the robotics division is Leo Gowon. Leo Gowon announced that Foxconn plans to unveil 2 versions of its self-developed humanoid robots at its annual technology event this November. One of them is a model with legs, and the other is an autonomous mobile robot with wheels. They said it will be less expensive than the version with legs, but did not disclose any further details. NVIDIA announced last April that it plans to build an artificial intelligence supercomputer manufacturing plant in Texas in cooperation with Foxconn in Houston and Wistron in Dallas. And it is expected that both projects will be able to increase production within 12 to 15 months. From NVIDIA's perspective, what about using humanoid robots for artificial intelligence server manufacturing? It means taking another step forward in this field of technology, as they are already supplying robot manufacturing platforms to humanoid manufacturers. That's pretty amazing. What this means is they're currently selling platforms that allow companies making robots to actually manufacture them. That's why, by selling robots like this and then using those robots to create artificial intelligence servers, you can see how a virtuous cycle can occur. That's how you can understand it. What about NVIDIA's Chief Executive Officer Jensen Huang? Back in March, he made a bold prediction that it would take less than 5 years for humanoid robots to be widely used in manufacturing facilities. Now let's wrap up with a final word from Mijun. If, as Jensen Huang predicted, humanoid robots become widely adopted within the next 5 years, I expect that this will add a significant growth driver to NVIDIA's revenue. Of course, at this point, it's difficult to predict the exact figures. However, Considering the assessments of market experts and NVIDIA's strategy, humanoids have the potential to become a tremendous core growth driver for NVIDIA, comparable to its data center business in the future. That's how I see it. Now, there are reasons why humanoids are expected to have such a bright future. NVIDIA is not just selling the chips needed for humanoids. NVIDIA has a plan to dominate the entire core platform that runs robots. In fact, NVIDIA has 3 core elements needed for the body of a humanoid robot. That means they are taking a strategy to provide the brain, neural network, and intelligence all together. First of all, the semiconductor that goes into the brain is essential because humanoid robots need to recognize and judge their surroundings in real time and move precisely. And for this, artificial intelligence chips with powerful computing capabilities are essential. NVIDIA is number 1 when it comes to artificial intelligence chips. And NVIDIA has already secured its position in this market by developing high-performance system-on-chips dedicated to robots, like Jetson Thor. The second is neural networks. That means software. Developing and training robots requires a huge amount of cost and time, but NVIDIA supports safe and efficient simulation and training of robots in a virtual world through the Isaac platform. Now, this is the famous digital twin. NVIDIA has this virtual reality, which is similar to the metaverse, called Omniverse. So inside this Omniverse, robots can actually perform various trainings. By doing so, you can save a lot of costs that would be spent on repeatedly building, failing, and improving in the real environment. Therefore, the speed of development can increase dramatically. That's how you can understand it. That's what I'm saying. We can also consider the possibility that the Isaac platform could serve as an operating system like Windows or Android in the world of robotics in the future. The third is intelligence. To go beyond robots that only repeat specific tasks and to perform more versatile tasks like humans, advanced intelligence is required. NVIDIA is creating something called a project group. Now, this is called a foundation model for humanoids, and it's a general-purpose artificial intelligence model that helps robots quickly learn new skills by mimicking human language and behavior. So, you can see that they're trying to replicate all the essential aspects needed to develop humanoids. So, like this, NVIDIA isn't just selling chips to robot manufacturers like Tesla, Figure, and others. They're also providing essential software platforms and artificial intelligence models for development, increasing dependence on the NVIDIA ecosystem. You can understand it as them basically selling their entire ecosystem. Why is this important? Because the potential of the humanoid market is enormous. As time goes by, the projected scale is growing rapidly. Compared to before, the outlook for the future size of the humanoid market is getting bigger and bigger. You can understand it that way. For example, in the case of Goldman Sachs. By 2035, the humanoid robot market is expected to be about $38 billion, which is 52 trillion won in Korean currency. That's their outlook. What that means is they've suddenly raised their forecast to more than 6 times higher than the $6 billion they predicted just a year ago. That just shows how much expectations for the humanoid market are skyrocketing. You can see it that way. And Jensen Huang himself has also mentioned that humanoid robot airports could become one of the largest industries in history. It's expected to be comparable to the automobile industry. In other words, the automobile industry is a huge market, and they're predicting that this market will be of a similar scale. NVIDIA can expect not only hardware sales revenue in such a large market, but also licensing from platform usage and software revenue in the form of services. So it's expected that the contribution to their sales will be very high. For reference, NVIDIA's revenue for fiscal year 2025 was $115.2 billion, and more than 80% of that came from data centers. On the other hand, the revenue contributed by robotics or the Jetson Isaac platform for edge devices only accounts for a single-digit percentage of the total revenue. It's still very insignificant. That's why I find it even more encouraging. From NVIDIA's perspective, the robotics business is still at the starting point and hasn't really begun yet. Therefore, it has limitless potential for growth. That's how we can evaluate it. In conclusion, the widespread adoption of humanoid robots could be a huge opportunity of a new dimension for NVIDIA. In the short term, it will generate stable revenue in the industrial sector, and in the long term, there's a high possibility of expanding into the household market as well. Therefore, there's a very high possibility that it will become a core business that surpasses the current data center and gaming divisions. So artificial intelligence isn't everything. I'll wrap up by saying that NVIDIA is very likely to gain another huge growth engine. The last content prepared for today is the WIZON podcast, which has recently gained sensational popularity. I think it's not just because I appear alone, but also because my wife's voice is featured, which is why many people seem to enjoy it. Now, today I'm thinking of covering a topic that's a bit unfamiliar. It's about self-driving taxis and the rise of the eVTOL market. Let me explain what eVTOL is. E stands for electric, V is for vertical, T and O are for takeoff, and L is for landing. If we translate it into Korean, it would be something like electric, vertical, takeoff, and landing aircraft. So since it runs on electricity rather than like a helicopter, it's much quieter. You can see it as a new technology that's getting a lot of attention as a next generation means of transportation. Recently, this has become a field that many investors are interested in. So today, through this article, I think it would be good to take a look at what investment opportunities exist in the autonomous taxi and eVTOL markets. As I mentioned in detail at the beginning of last Saturday's broadcast, together with Chief Executive Officer Kim In-jung, I am preparing a very special live broadcast on July 3rd for the Mijun members and ChoiceStar members. And in this live broadcast, we are planning to reveal 5 new stocks that we should pay attention to in the second half of 2025. Now, one of these stocks is something we should also be interested in for earnings before interest, taxes, other, and litigation. Because the market potential is huge, but the market penetration is still very low. Now, if we can find the number one stock in a huge market with low penetration like this, we can expect healthy returns in the future. Anyway, I've selected these 5 stocks, and I hope many of you will be interested in Mijun Live, where we'll analyze them in detail together. Alright, that's it for today's broadcast. Thank you for joining me for the first broadcast of the new week. Let's all keep fighting together until the day we all retire from investing in United States stocks. Have a happy day, thank you. Hello everyone, did you have a good weekend? We were also invited to our British friend's house for the first time in a while, so we had an enjoyable weekend. It's about 20 minutes from Cambridge, and walking through the wheat fields while watching the kids play made me feel a new sense of energy. Hello.
This is Omiju. The weather is so nice because it's summer. We also played a new game called croquet together. Now, since a new week has started, let's go through the things that Mijun has prepared so well together. Today,
I'm going to take a deeper look at 2 technological trends that could change the landscape of future transportation. Specifically, Tesla's robotaxi service and the rapidly emerging eVTOL, electric vertical takeoff and landing aircraft market. Today we'll be looking at 2 sources. One is a familiar one from Jin Monster's Diverter, which is an economic analysis of Tesla's robotaxi. The other is a report on the potential of eVTOLs released by Bank of America through Seeking Alpha's Liu. Let's take a look together at what these sources have to say about these game changers and what they might mean for you. Yes.
all right, then shall we take a closer look at Tesla Robotaxi first? Since this is starting its pilot service in Austin as soon as next week, it's really just around the corner. At first, they're starting with just 10 vehicles, but Musk said that if the initial results are good, they could increase to 1,000 within a few months. Of course, the most important thing will be safety.
Going from 10 to 1,000 vehicles is really aggressive, but according to that Diverter article, the revenue model is pretty interesting. It's not just 2 things. One is the asset-light model. Tesla owners put up their own cars, and Tesla takes about a 30% commission. I guess this way, the expansion speed would be really fast. And
from Tesla's perspective, there's much less financial risk. According to the article analysis, if we assume the current rate level continues until 2030, or even with a 10% discount from here, if they capture about 30% market share, their operating profit could increase by 32%, and if it goes up to 70%, it could increase by 74%. That's how I see it. If they take a more aggressive approach and raise the rates by about 5% every year, the increase could go from 40% up to as much as 94%. 94% is huge, right? Yes.
on the other hand, there's also an asset-intensive model. This is where Tesla owns and operates all the vehicles directly, and of course, the absolute profit scale could be bigger with this model. The operating profit growth rate can range from about 53% to 125%, and if they raise the fees, it could even go up to 68% to 160%. But the problem is, as you know, since they have to make all the vehicles themselves, they say they'll need about 550,000 to 1.3 million vehicles. So the rate of expansion is slow and the capital risk is much higher. So
it's a dilemma between capturing the market quickly or aiming for higher profits. But in the end, for the asset-light model to succeed, it really depends on how many Tesla owners participate. If it's an annual income of a few $1,000s, it's tempting, but when you think about your car being used, getting worn out, and having to clean it, you might hesitate. Yes?
you're exactly right. The article points out that very issue. Because of practical issues, the actual participation rate might be less than 20%. They seem to take a rather conservative view. But here's another interesting thing. Even if the participation rate is low, only about 17% of all Tesla vehicles would be enough to achieve a 70% market share. That's about 1.3 million vehicles, so it means that maybe not as many cars are needed as you might think.
Even with just 17% participation, it's possible to achieve a 70% market share. That's surprising. Then what about the cybercab that Tesla is planning to make themselves? If that asset-light model works well and a lot of car owners participate, doesn't that mean Tesla won't really need to make a lot of cybercabs?
They estimate that the number of cybercabs needed by 2030 will be lower, around 200,000 to 400,000 units per year. In the end, how quickly autonomous driving technology is completed and gets government approval will determine the pace of all this. Even in the most aggressive scenario, they expect the autonomous driving operation rate to be about 70% by 2030. It still looks like it will take some time. Yes?
All right. Now, shall we go from the ground up to the sky? EVT, Electric Vertical Takeoff and Landing Aircraft. Bank of America has huge expectations for what they call the at least economy, meaning the economic activities that will take place in the low skies above our heads. They're saying the annual growth rate between 2025 and 2030 will be as high as 62%. That's practically explosive.
That's right. Basically, it's a helicopter, but since it's electric powered, it's much quieter, cleaner, and also a much more affordable alternative. You could say it's a combination of drone technology and vertical flight capability. It has great potential to be used in a wide range of fields, from logistics and delivery to emergency services and even commuting within the city. There are reportedly over 1,100 models being developed worldwide, so the competition is really fierce.
100? Wow, will all of those really be able to fly in the sky? Or in the end, will only a few companies survive? How does Bank of America's report predict the growth path?
They divide it into three main stages. The first stage is from 2025 to 2030, when they just get certified and are in the early adoption phase. It seems like it will mainly start with public services or tourism. The second stage is between 2030 and 2035, and from this point, it will spread further into commercial transportation, as costs go down and demand increases. And after 2035, as operating costs are further reduced, it will be adopted on a much wider scale. So by around 2045, it's predicted that about 250,000 eVTOLs will be in operation worldwide, and the urban air mobility market could grow from its current size of about $3 billion to as much as $210 billion. $200 billion.
Wow, that's a scale that's hard to imagine. Then, how does this eVTOL compare to existing means of transportation? According to the report, for distances of about 150 kilometers to 400 kilometers, it's faster than cars or trains and cheaper than helicopters. For relatively short distances of about 50 kilometers to 150 kilometers, it could be a slightly more expensive but faster premium option. But for this to really become a reality, building infrastructure like landing pads and vertiports must be really important, right?
That's right, that's a very important point. Robot taxis can basically use existing road infrastructure, but eVTOLs require completely new infrastructure, like vertiports. This is one of the biggest differences and also a challenge that needs to be overcome. In the end, the future of both of these technologies depends on how mature the technology becomes, whether they can pass government regulations, and most importantly, how willing people are to accept and use them. In the future transportation market, these two have the potential to compete or complement each other, and they could bring significant changes to the existing automobile industry, ride-sharing services, and the aviation industry.
They both seem to show incredible potential. At the same time, the challenges like regulations, costs, and the speed of adoption don't seem easy to overcome. I'm curious what this information means to all of you in the Mijun family who are interested in technology trends.
Yes, the materials we looked at today are only presenting possible scenarios. We don't know how things will actually unfold. It seems like this is a field we need to keep watching with interest. Yes.
That's right. Lastly, I'd like to wrap up by asking you all one question. How do you think the autonomous driving network on the ground and the air transportation network in the sky will either merge or compete with each other to meet the mobility demands of future cities?
And I think it would be interesting for you to imagine what new business opportunities might arise centered around these new forms of mobility. We will return next time with even more interesting analysis. Thank you.